This is Justin Pulitzer. This is my weekend review video for Sunday, August 23rd, 2015. Heck of a lot going on in the market. I'm going to just dive in. As you can see, I'm on the crude oil chart. This is sort of where I've been starting lately, starting out with this big macro themes. And you can see oil has just been bleeding off every day for weeks now. We're below these reference lows in the 42s. And it looks like oil wants to make a retest into some much older reference levels. I don't know if we necessarily are going to fully get there, but the 2008 and 9 crash lows took oil down to 33.20, and then there had been an older breakout around 37. So it seems like we may have to resolve down here before a potential bounce. We'll see. I do believe the conditions of oil are being affected by a few things. One has been the improvements in horizontal drilling and fracking technologies. I also believe the Saudis are engaged in a supply war, supposedly. This is the big story that's been going around, that they're looking to kind of hurt their smaller American player counterparts, as well as other international players, maybe such as Iran, now that they're going to be having the deal that went through, the nuclear deal, which is going to allow, I think, 3 million or something barrels of Iranian oil coming in. So there's been a lot of supply here. I don't want to say it's only supply. I do believe there has been some demand destruction. And I've been talking for a while that I believe the problem here is deflation, not inflation. And I've been talking about this lower for longer thesis with regard to Federal Reserve interest rates. And that has been playing out. I'm going to show you that what that looks like in terms of the TLT. Let's go back. Yeah, actually, it's good we were on this chart, but if you take a look at the 2009 crash peak, we have remained stubbornly high in terms of low interest rates. We had made a new high, had a pretty large pullback, and now we're bouncing into some important reference levels. So you can see that I've been talking about being above 23.15, being bullish, and that we could potentially see this gap fill and maybe even the 61.8 fib here of the high to the low. This would be the retracement. I do believe up here there will be some very interested sellers of people who paid up, and then they got caught up in this breakdown. So potentially up here we're kind of seeing the end throes of this. If we do go into recession, and it is confirmed, which it is not yet, although I do believe that that is kind of going to be the case, we could come up and retest the old all-time high. Anyhow, I believe that the Fed will be on hold. I think that consensus now is starting to recognize that the September rate increase is increasingly unlikely, and the potential of maybe even a 2015 and potentially even a 2016, if the data keeps coming in as poorly as it has, might be fully off the table. And you can see the dollar is starting to respond to this and rolling over a bit. This is sort of a mini head and shoulders. It had the neckline break. Wouldn't shock me to see some type of a rally here as a throwback. You also have a 200-day moving average that are coming up, some reference lows down in here with some kind of horizontal trend support, also a volume distribution. So it's possible we get a little bit lower on the dollar, but I don't think it's going to completely fall apart. There could be some type of a bounce at some point. The big fear, of course, is if the dollar spikes up, makes some new highs, and keeps going, that will be hurting the earnings of international companies, some big global ones. I'm going to discuss those in a moment. I just want to do a quick brief interlude to the VIX, which is absolutely exploding. This here I had mentioned I thought was potentially a secure low with a look into the 10s, making a new all-time low below this 1153, and it kind of consolidated, and then it's just been in launch mode. So you are now over all of these highs, and obviously the trend over these highs as well, which was a pullback I think there was a lot of fear into. So this movement here, I've been saying for a while that there are levels in VIX. 20 has sort of been the range high, and there's always, I guess, these sort of more deeper corrections with sort of panicky elements to them that can get you up to like the 22s and 25s. And you can see on Friday we really this is like a gap and go. So I don't necessarily know if these levels in terms of VIX are sustainable. It is if we are going into a crash mode, which is a whole other story. But let's not get ahead of ourselves here yet. So if you're long stock, it's not a bad idea to start thinking about selling maybe some out of the money or near the money call premium, because that's very expensive right now based on VIX. When you're in a low volatility environment down here, your big concern is sort of your delta and gamma risk. I don't want to get too much into what those Greeks mean, but as you get into an elevated VIX environment, people often overlook Vega, and Vega risk is real. It often is the most dangerous of all of the Greeks' risk, and I'm not talking about the Greek stock market, I'm talking about the option pricing model, because often when this happens, you not only have price going against you, meaning your delta is going the wrong way, but you also have implied volatility that is going against you. So if you're short, like put premium, for example, this could absolutely this is devastating. I mean, you have the beta exploding, Vega exploding, and it's just trouble. If you're also long call premium here, any pullback in VIX, like even believe it or not, amazingly, if this is 28, if you were buying calls on Friday, if you get a rally in the market, like let's say Monday is a bounce day, and I'm going to discuss what I think of the indices in a little while, but even if this pulls back to 20, you could get murdered on those calls because the IV is coming out so strongly. So you might have direction correctly, but you might have price wrong. So you might have the direction going with you, but you might have the IV going against you. So I do believe that this is a more premium seller environment than I would be a buyer. Anyhow, that's the VIX. I want to show you guys some indices and some stocks, and I'm going to give you my take on it. I don't cover a lot of these very often, but they're big, important stocks, and they're the ones that the market, believe it or not, the market doesn't really care about Ambarella. They care about big stocks like Exxon or Disney or Procter & Gamble or Walmart. These are what make up the big Dow indices and a lot of the S&P. And I want to show you some of these charts. I clicked the wrong button here. Daily 9. Let's go a little further out. I want to show you, let's say, like a 5-year weekly chart. So you can see that we've been in a steady, protracted up move for quite some time. And then we started flipping over into this more sideways consolidation mode, and we've been kind of consolidating. I guess you could say the market has poor highs for a while, and often poor highs result in a liquidation break. Sometimes they can be quite large. This could also be forming what's known as a complex top. If you go back and you take a look at the 2007 top, let's do that quickly. 10 years weekly. You can see here that there was like a lot of this push and pull. You had the initial breakdown, sort of the check back here, and then the inevitable smackdown. So this here, if this is going to be like a 2007 scenario, we're sort of right around this area here where we're just making this first initial break below this long consolidation area. So I am expecting something similar to this where there will be some type of a check back, but it could be precarious here. I'm sorry that this is going to be a kind of quick and dirty charting video because I had some issues with my my platform this week, and I actually wound up having to reset, and I lost all my charts. So all of the stuff you're seeing is new. It's sort of the quick and dirty. It's not as I've been going along. I have to go back and recreate them all. But for the purposes of this video, I needed to get something done for you guys, and this is what I did. Often this could be a blessing in disguise because I can maybe notice things that a sort of a complacent chart hasn't picked up on. And you can see here the Dow, in terms of the diamonds, are at the major primary trend line. We're coming into it we're in a weekly chart. So this is going to be really key, a few points lower here. I would say that it's really kind of it's kind of go time in terms of the if there's going to be a bounce, we're in multiple days down. It starts off slowly. There's this push and pull, and now there's sort of this more panicky move down. So it wouldn't shock me if there's a little bit more move down here in the Dow to retest this. Oops. The one concern I have with that. Well, let's not do SPY just yet. I want to show you some of these big Dow stocks actually before I get into SPY. You can see, look at Exxon. I mean, this thing has been really getting ugly. We're through the 61.8 here. I think I need a longer time chart. We'll hang out on 2 years for a lot of this video. But you can see that this has been in sort of this more protracted downline. It's sort of getting a little bit steep here. So I wouldn't be shocked at some point to see some type of a rally back in Exxon. I don't know from what level it's going to come from. It could be, believe it or not, even in 66s. But I do think that there's going to be some type of a check back somewhere to like this breakdown here, which was like 80, close to 83, 82.68 to 83-ish. This sort of was this would also be a gap fill here. I wouldn't shock me to see that at some point, but this is starting to get a bit steep. It's the more of the panicky phase, which I guess is sort of good. You can see here it's had these periods of these long bleed offs. This is now getting steep, so I do think that there is some potential for a little bit lower, but I do think that there is going to be some type of a bounce in that. The big problem here is Exxon, believe it or not, is still trading 13 times earnings, and that's with oil prices declining. So that, while that multiple has come in quite considerably, it's still not sort of the cheap. Markets start getting, with these big stocks, unsustainably low when they get below 10 times earnings, particularly in the broad indices. So that's Exxon. Disney, another one that I think a lot of people have been looking at. This is a couple of different time frames. You can see I drew the Fibonacci's from. On one time frame, we are getting close to a 61.8 Fibonacci retracement. That was from this entire run here. And it also would coincide roughly with a gap fill here. So I'm kind of looking for this area here around the 94.10 to like 95.17. It bothered me a little that we rallied a little bit off the low on Friday. It would have been great if we got some type of a full check back here. And you know how this market likes to roll. It wouldn't shock me to see some type of a premature bounce. But this area down here, I'm going to be a very near-dated put seller, particularly if it happens early on Monday, or Tuesday. If we push a little bit past it into the even into 91s, we'll see. I do think that this area here in these last few dollars is going to be the area to kind of buy the dip for at least for a bounce to come back up, maybe even to the 104, or maybe it even gets to 106. We'll see. It's going to depend on how strong the market is. But Disney also, believe it or not, is trading still down here after all of this pain. It's still trading 20 times earnings. And if the economy is slowing, there could be significant room to still fall. So I just want to show you, as much as some of these stocks have fallen, they're still not really that cheap. Look what's happened to Procter & Gamble. This isn't a biotech stock. These guys make toothpaste and toilet paper. And even after this amazing, stunning decline, we are now below the 2007 old top, which you can see was support many times. It is now, we've broken below there. We've broken below a secondary trend line. The big 61.8 doesn't even come into play until 63. But as much as we're down here, based on current earnings, and this isn't a company that gets a lot of earnings growth, it's still trading 23.5 times earnings. That's an amazing multiple, and that all is because the stock has a 3.69% dividend. There's been so many people chasing yield that they've been piling into these stocks, they've been crowded, they've been paying up these amazing multiples for these companies. And now that the companies are coming down, I presumably maybe there has been some fear about interest rates rising, although they have been going lower. But and all of the inputs I showed you, oil is coming down. We all know copper and a lot of commodities are coming down. So these companies should be minting money, yet their stock price is coming down. So this is weighing on some of the major indices, and it's also weighing heavily on, I guess, funds that are piled into these They are probably going to have some forced liquidations. There's probably some margin calls and stuff. I think this is also a lot of people who have been burned in a lot of various other markets, and they're kind of selling their winners or what they can, big, deep, liquid stocks, to kind of carry what they can't get out of. That was what happened in 2008 and 9. I don't want to rehash that crash, but there are some this is what happens in all crashes. So, and I'm not saying that this is a crash, although a lot of indexes have crashed around the world. Brazil is in crash mode. Russia, India, China, I'm going to go over those shortly, but I just wanted to point out that even with this stunning decline, that this stock is still not even that cheap. The same thing, believe it or not, goes for Walmart. Look at this. This is a stunning, disgusting chart. I mean, people are shocked that the S&P is breaking down and that the Dow is breaking down. I mean, look what happened here. A lot of defined support in the 72 areas, and this was just a gap and go below. Like this is some kind of like spec biotech stock. I do believe that this 66 area is a really key level. If not, we could even see the 61.8 down here around $60. I'm going to start looking to maybe sell some puts or kind of nibble longs down somewhere into this area. But again, as much as this has come down, and here it was more, this was still like 15 or 16 times earnings, we are still down here trading at 13.5 times earnings. Again, you're assuming if the economy is slowing, these guys' earnings estimates are going to have to be cut, and this still might be expensive. As amazing as this seems with this big move from $90 down to $60, the stock has been demolished, and it still isn't super duper cheap. I am expecting at some point there will be some type of a throwback. What was support now becomes resistance, and as we rally back up here, all the people who kind of bought the dip or were playing the hope and pray game are going to be made whole, and we'll either see this thing now really collapse, or it will, or if things are improving, they'll accept and we'll go higher. But these are some really major stocks that make up these big indexes. We're getting close to a 3% dividend down here. I think when it gets closer to a 4% dividend, this thing would be an absolutely nice buy, but still not really cheap. Look at J&J. This one hasn't really succumbed yet. I mean, it is down, but I mean, it doesn't have that completely, complete cracola in the chart yet. We are now first starting to break some really big ranges here. The low here was 97. We are now below there. So we're going to, there is some reference support here down around the 95s. That's where we got around. So this area is really key to hold. Amazingly with J&J, we are now at a 3% yield, which is nice, but it would be better maybe if it was a higher percentage yield down here. But still, trading 17 times earnings. This even after this move down, it's really still not cheap. I'll show you the same thing again in Nike. This is one that's going to be affected by the strong dollar. Look at this. We had a high here, a lower high, and now we're kind of breaking into range back into sort of like the breakout area. So this chart hasn't really completely fallen apart yet, but believe it or not, Nike is trading at 29 times earnings up here. These are not cheap earnings multiples. I mean, yes, they've had some really great growth. We all know, I think a lot of this was factored in based on China growth. We'll keep that in mind when I talk about tech and Apple in a little bit. But these are now some major technical, these are some really ugly candles that are kind of chart changing. If there's a move back up here, there might be some, resistance now. And it's now, people are a little bit iffier, like if you're coming off of an all-time high, and we kind of still are, but it is now off of a lower high. You're making lower highs and lower lows. This is a very not so great pattern. I will be looking for this for a buy for right or right out, roughly in here at the channel low. It will hopefully coincide with this 200-day moving average, and I will be looking for that for a day trade or even a swing trade for some type of a right or right out move if it winds up coming down. Home Depot, another one. This is about as ugly of a chart reversal as I have ever. I wouldn't say that I've ever seen. You'll see in Amazon, that's even worse. But look at this. You gapped up on earnings. You had these kind of like spinning tops up here, which is sort of like a couple of day island reversal, and then reversed hard. And this was on great earnings and a media love affair. That's not good. And you are now below this old reference high here of the 117. I do believe that there is going to be some support coming up a few dollars lower. You can see this was sort of a big congestion area. It's also a little bit of a volume node. It's also a primary sort of trend line from this low, although if you want to talk about primary trend, we're way back there, but I wanted to show you guys something that might be actionable in the next few days. And there's also a 61.8% Fibonacci here in the 113s. That type of action to me would be a good right or right out area for some type of a bounce. So if you're right, you get the bounce, and if you're wrong here, you just GTFO, which means get the F out. Amazing. This stock isn't even down that much. They've been kind of the darling. The housing market has been doing well. But guess what? Here, 23 times earnings. Not a cheap stock in the least. Let's get into the S&P 500. So SPY here, I drew these boxes here just to show you anyone who is bought in this period of time, and this is quite some time. Look where this box really starts back over here. It's in July, right? Yeah, back all the way in 2014, so over a year. Anyone who's bought up here is now wrong or kind of not getting rewarded for their efforts in terms of their buys. So we are at a really key level here. You can see there are some reference lows here, down here at the 197.86. We closed here at 197.63. So we're kind of close to these levels. If this is a really, really key area. One thing I want to note, this is a channel that is drawn from the 2011, the debt ceiling lows. I don't want to go back. We've already spent a lot of time on this, and I have a lot more symbols I want to cover. But you can see we are now below that channel low. That is really, really bad in my view. You had a lot of support here in the 204s. You had a gap fill here around 201.92, which I've been talking about. I had said I thought that this area would be a support level, and not only wasn't it a support level, it closed on the dead lows here. So what I'm thinking for next week, believe it or not, there is a almost a $9 expected move in SPY with this crazy 28 VIX. I don't know if you'd get that on the way up as much as you might on the way down. A move on the way down would take you into like 88s, 89s, and that roughly coincides with this gap fill and close to the 78.6% fib. So that's kind of if this keeps going and it kind of gets crashy, like if we have a bad open on Sunday futures. Right now it's only around a little before 4:30 on Sunday. So I haven't had the benefit of seeing the futures yet. But if we have like some type of an ugly Monday and like maybe a follow through crappy day Tuesday, like. I hate to say Black Monday, terrible Tuesday. It's so cliche, but whatever. If we have some type of more of a crashy type of a move into or the early part of the week, I do believe down here would probably be a good area to kind of buy for some type of a bounce, and play that back up into sort of where the sort of the old support had been up in these 204s. If they were to get the $9 move to the upside, and I don't know that we will, that would take you to 207s. I mean, that would take back all of this weakness. If we did get back here relatively quickly, I might be willing to say that this was a liquidation break, a look below and fail, and then maybe we have the blow-off type of scenario where you shook everyone out and then it just goes parabolic to the upside. I don't know that that's going to be the case. I think that would probably be the most painful non-consensus trade at this point, just because so many people have gotten probably their head handed to them the last couple days. Believe it or not, I hate to say that but this is really just kind of a love bite in terms of how ugly market corrections can get. This is just kind of the beginning stages of a potentially larger come down. And if you think about it in terms of percentage wise, we are only now first about 8% off. Everyone talks about this full 10% correction or 15% correction. We're about at 8% here. If we do get the full 10% correction, I mean, it's really not that much further off from where we are. But if that were to be the case, that first takes you down to the 192s, which is down here. Again, there could be a little bit of an overshoot for that gap fill, so that would be consistent kind of with that with that larger, with what I guess the media consensus type of a move would be, what the talking heads look for on a daily basis on the I don't want to mention any names or whatever. If we do wind up getting the full 15% correction, though, oddly enough, that is right around here where the 181s are, and I think that would be enough pain that we could probably hold and sustain there for a little while, and then maybe we would get the bounce back up sort of to this area, to the 197. So this could be a good thing if you want to play, put ratios or put spreads on a move. I would definitely do the put ratios into weakness. If you want to do the spreads, you might want to wait for some type of a bounce. We often crack channel lines and then retest them. This day here closed 23 in the S&P futures, so this would be $2.3 off of the VWAP for this day. And here we were $3 away from the VWAP. So this has just been a complete cascade in price. Again, why did this happen? You remember we discussed the Fed day and what I discussed about those ranges. Here we sort of had a look below what was a triangle and fail. We had a look above the downtrend and fail. And now we're kind of looking below a longer, I guess, a kind of a longer-term channel. We'll see how that goes. It would not shock me to see some type of a throwback to here, to the 204s, and then it's kind of decision-making time if we're going to roll over, because that's a volume distribution and old support, and then kind of do one of these and then do one of those, or maybe it just does wind up, like I said, doing the blow-off scenario. But those are the levels, those are the key levels to be looking at. So right here, maybe there's some type of an oversold bounce. The world didn't end. We didn't have war with Korea. That was something that was a big concern on Friday as well, which I think exacerbated the move up. But it wouldn't shock me to see some type of a relief rally and retest the backside of the channel at the very least. That will be a really good right or right out type of a short play, somewhere between that channel and these 204s, if you want to play for row short. If we do wind up coming down still lower, the 194s or the 61.8, and then down around these gap fill areas around 89s and 90s, I would be looking the IV at that point. If we came down here like on Monday or Tuesday, if it was that steep, this is like 1, 2, 3, maybe 4, 5 days down, I'd be looking to sell these 181s because we know that that's the 15% correction, and we also know that that is a reference low from back here. I do believe that would be a good I would think would have enough price memory for a support for a bounce. And if you can sell some out of the money puts that are around here, this is probably where you want to, at the very least, long up just for a bounce play. This is still coming off all-time highs. Waves in crashes or major corrections tend to be waves in threes, so this is only really would be considered, in my view, wave one. So there should be a bounce at the very least. This isn't going to just completely collapse and we're going to go, completely anywhere. Bear markets don't end in a day. Bull markets don't end in a day or a couple of days. But this price action definitely has my attention. It's definitely gone a little bit further. We didn't violate here, so it has caused some technical problems with regard to breaking the channel, but we haven't really lost the range completely. It's kind of like holding on, I would say, by the fingernails here. So it's kind of really put up or shut up time. If we, Monday, it would really behoove the bulls, I think, to get some type of at the least a bounce to kind of just keep the dream alive, so to speak. But the price action is definitely starting to look really iffy. IWM has been even weaker. We've lost that 120.58, 117.37, which was, if you've been watching my videos for a long time, a large point of contention. But we are coming down into some key levels. If you look at this measured move, this would take you down to the 111s. It's just a little bit below the 61.8, which is 113s, also some reference areas. So it wouldn't shock me to see, because also you can see near where a gap fill was, where this took off. So there could be some more pain in IWM. Believe it or not, $4 or $5 is a lot of pain. But, it could set up here for some type of a right or right out bounce, or if you want to do some put ratios with, the terminus maybe being 109 because it's the 78.6, and there's also some reference lows around these 107s, your break even there would be significantly lower. So I do believe that would be the setup for IWM. Qs, we're going to cover a lot of the momentum stocks, same stuff. A lot of people are underwater here. We're back to a 50% fib of this entire range. There's a 61.8. You can see this is still stronger than SPY because this is sort of where we're getting closer to in terms of time period. So I think somewhere around these 99s will probably have some reference. We are kind of back into the middle of the range. It would not shock me to see this. I know, as ugly as this looks, it wouldn't shock me to see this support here just because sometimes you come to mid-range. This was an old high area. I am looking for these 99s here to support. I'll probably be looking to buy Apple or sell some out of the money puts at that point, and I'm going to show you why. With regard to Apple, this is a bit of a complicated chart. This isn't my normal one, as you know. I told you about the charts being losing my charts, and this was just kind of a fast and dirty put back together. But this was an old breakout here, the 119.75. We kind of checked back here, didn't quite get the 200-day moving average, rallied back up, kind of broke this downtrend, and then just collapsed. This was the earnings gap low of day. I said anything below 121.99, I had just called it 122, was vulnerable. We came back down here. We filled this gap. We got almost. I mean, we stopped just shy of pennies. But we should have had here a secure low here. If you look at this elongation, this is excess, and it's bookended by higher lows. We came back up. Actually, before that had happened, we had a rally back up here. I had been looking for this to press a little bit higher. We got into the 119s. I had been looking for maybe 122s back to the earnings gap low of day. I guess that turned out to be a little bit too optimistic, but it wound up rolling over. We're now below there. The good news for kind of the Apple bulls, or the people who are looking to be opportunistic, is that you have a reference breakout here around the 103s. The old top from I think it was 2012 or whenever before. See if I can show you guys that. I guess the Wayback Machine here isn't enough. Let's get a yeah. You can see here. This was the 100.72. It would not shock me to see it come and pull back into that area. It also coincides with a longer-term trend line, as you can see. And it also is the kind of a gap fill down in here, the old high, the trend. I do believe that this will set up for a really major bounce in the market, and also in Apple. So, if we can get a move down into here, and we don't do something silly like rally ahead of time, like this market tends to like to do, I think you can get enough of an excess and a washout there with some reference areas that it would be a good buy. I don't know that this means that the move in Apple is, the down move is lower. Believe it or not, there are these reference lows at a 50% fib at 50%, 50% fib at 95s. And then the big 61.8% fib from these lows to these highs comes in around 85. So if you want to play this sort of the Chicken Little way, if you come down here, you can sell some longer dated, maybe out of the money 85 puts, because the IV will be up so high. There's an Apple VIX. I don't want to go into it, but it's crazy high right now. It's like the other VIX at the higher end of the range. That usually kind of happens more toward the end of a move than at the beginning. So I would be looking to maybe even to play it two ways. You could play this right or right out with shares. You could play this right or right out with weekly short puts. Or you can sell maybe some longer dated, or maybe it won't even have to be longer dated. If the VIX gets up so high, you could sell some near dated, a few weeks out, the 85 puts. Google. Also, I guess showing some weakness, but not relative to the rest. It is, well, here we go. We did have some reference highs here in Google around the 615 area. I'm sorry it's not drawn in my charts. Around the 608 to 615, you can see the 602 roughly here is close to the gap fill. It's also the 50% fib. So if we got down into there, I think that you could probably sell some out of the money puts. There might be some type of a further push to the 61.8 or close to there, because that was really where this breakout was between these 83s and the 75s. I'd be looking to sell some out of the money puts somewhere between this gap fill and here. So somewhere between the 602s and the 5 and the around, let's just say around the 602s, somewhere in here. I would be looking to sell these kind of puts, or maybe puts that are like down in the 560s, which are closer to the the trend line. So if we get down to close to 602s, or maybe press a little bit lower, I'd be selling these 555 puts. I think that would be a good play for some type of a bounce play in Google. Amazon looking really, really fugly. You could see the 408.06 was the reference, was the old reference high. We gapped up like this. Look, this had ran up. No shocker. It was a gap and crap. It consolidated a bit. It had the bounce off the 20 and now is just coming back down to fill the gap. I don't know that this is going to hold it because this kind of came up. It wouldn't shock me to see a bit of a deeper pullback, maybe even into the mid of this range where this kind of began, into the 439s. But if we can get somewhere down into here around the trend, I'd be looking to probably sell these puts, depending on how long it takes. Like if it takes forever and it like just meanders down with false rally, like the quicker the better, in my view. I'd be looking to sell something around these old highs, like some 408 puts. Maybe if we come down a little bit farther into like the 452s or even closer to the trend, I'd be looking to sell these puts or lower for some type of at least for the very least, a bounce in Amazon. This is now still coming, believe it or still from all-time highs, this consolidation, but this is, people will still be interested who missed the run, I believe, in Amazon from the all-time highs. Facebook, we all know my love affair with Facebook for a while. I have been saying that I thought 100, and I had mentioned in some tweets that 99 to 103 was going to be some of the sell points, and that wound up being correct. We are now coming back down into some important reference areas, the 85s. This was like the breakout. A lot of this move here did not happen on Facebook's earnings. This happened on Google's earnings, and I think we've just been kind of working off the excess and paying the price. Also, the weakness in other social media. I don't want to mention too much into Twitter and LinkedIn, but they have been very weak. Yelp has been getting yoked. I do believe somewhere between these 85s and 82s, you can see there was a lot of reference support down in these 81s to 82s. So somewhere in here, even if you want to sell some out of the money puts as a long proxy, I always like to do that. I believe that we are now getting down into some reference levels around between these 85s and 83s, even 84s, that there could be some good out of the money put premium sold, maybe the 80s or the 82s, somewhere in this area. I think that those are the kind of the strikes you want to be looking to sell. Oops, Netflix. Come on, Netflix. There we go. If you look at this stock on a monthly chart, you'll probably be disgusted. I'll show you that in a minute. This is starting to look a little bit like a Head and Shoulders. I had discussed in a couple of videos ago, if you wanted to use these highs, if you're short to play against, that has really worked. It's not one I took just because I didn't really see the urgency to be short Netflix, although in retrospect, you can see this you probably would have been a little antsy for a while, but it did work. I had been playing some put ratios, which I think were the right move, and those are good. But as far as an outright short, no, didn't take it. But the stock is coming down significantly. It's getting close to this gap fill. Look at this channel. I mean, this has just been trading in gaps and gaps. I would start getting interested probably closer to this breakout level. I don't know if you're going to get this stock cut this much, down to like close to $70. But if the market is going to get itself into crash mode, it is possible. I'll probably be looking to play this for some type of a right or right out trade. Actually, very quickly, somewhere around the gap fill here, around the 98s, 99s. It's also the backside of this old up channel. So I do think that there will be some price memory there. Maybe you get some type of a bounce. I don't know if it's going to get fully to the 118s, but it wouldn't shock me to get a little bit into the 112s or something somewhere around those areas, maybe to fill this gap here. So I am going to be looking for some type of a right or right out type of a trade, a little bit lower. I don't know, Monday we could gap lower, but if it is regular trading hours, this could be an interesting area. As I said, we're really kind of far away from the more, the primary trend down here and the bigger fibs. But if we do keep coming down and, in a sharp fashion, selling some out of the money puts down there would be good. And, obviously the ideal scenario would be, if we did get that full kind of washout and reset on Netflix. Not so sure that's going to happen. The model is good. We all know the business is going gangbusters, but everyone seems to love the stock. We're running a little bit over in terms of time here, so I'm going to cut out some of these stocks and just kind of skip to price line. The move here has been pretty much the same, par for course. Another gap up and crap, filled the gap and then some. We are coming into some of the into 50-day, 100-day moving averages and some Fibonacci levels. I don't know that we necessarily get to the primary trend in the 61.8, but if we do have some weakness here early on in the week, I think 1,145 would be a good row spot against the 61.8 and the trend, maybe even to sell some out of the money puts. I don't know how jacked they'll be at the time, but I do think that a move like that, there should be some type of response at the very least. I just want to show China quickly. I was going to skip this because, but let's do it. Primary trend, you can see from back in the day here, is coming up. We're getting close in the 35s. I do think that this should be some price support. If not, there is more down at the 32s. That's the big 61.8. There's also some reference lows kind of close to there. So as we come closer to this area, I'm going to be looking to sell some out of the money puts in this at the very least some type of a bounce. I did some here. They worked out well. I had taken them off, so I'm going to be looking to play that game again with FXI. I just want to show you one more thing. Brazil, this is through the 78.6. The 100% retracement is down to like $5. I don't know if we're going to get there. This thing has like a 4% dividend at this point. I actually am starting to nibble a little bit down here, fully aware that this can still go lower, but I am, like in the IRA, a little bit just nibbling a smidgen just for a tester. So that is that. Let's go back to, and we'll end on Tesla. How's that? Everyone likes Tesla, or at least likes to talk about Tesla. So Tesla has a trend line. I use this low here as my fib for my sort of my fib analysis. I also had one from this low. So we're getting. They had done a secondary. 42 was that price. Anything below 42 to me is a little bit iffy. I do think that the 221s could be an interesting spot for some type of a row bounce play, but I would probably be a little bit more interested down near the primary trend and the 78.6. This was also a very large point of contention. It's not really marked on this chart, but take my word for it. Around the 203s and the 205s, you can see this was where the resistance was here before came down test support and then kind of took off from there. So I do believe that in this area would be some more valid support for Tesla, at the very least for a bounce. We're making lower highs, lower lows. We're below the $42 Elon Musk price. Anything from the secondary, anything below there to me is iffy and still a play for the short. Maybe some put spreads or put ratios with terminuses down here I think would work well. Anyway, this this video is long enough. That's my story. I'm sticking to it. Be sure to follow me on Twitter. My handle is @JustinPulitzer. Be sure to subscribe to my YouTube channel. That is Justin Pulitzer Trades. If you like the video, just hit the thumbs up button below the video and also hit the subscribe. You'll get notifications on other weekend review videos as well as Periscope rebroadcasts and special edition videos. So let's have a good trading week and cheers.